Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Chris Englebert, founding partner and CIO of Englebert Financial Advisors. We're going to discuss how RIAs should most appropriately advise clients when it comes to job changes and job status changes. Chris, it's great to see you again. Welcome back to Trade Talks.
Thanks, Jill. Great to see you too.
All right, and the big story for 2020 and 2021, in fact, going into this year, is the Great Resignation. I'm sure in the course of your practice, you've been asked a lot, what do I do now? I'm leaving my job. What do I do with my retirement money?
Yeah, Jill, we're calling it the Great Resignation Part 2. If you remember a couple of months ago, we talked about the changing in the workforce, people resigning, moving to other jobs, et cetera. And we're really seeing an acceleration of that trend right now. And we're really doing a lot of strategy and counseling because, the easy part, obviously not the easy part, is when somebody changes a job, they get a new job, but they've got to make sure they focus on signing up for their 401k, 403b, or 457 plan. But the other important point is not to leave their 401k or 403b or 457 behind. So, we're really trying to get people to focus in and hone in on that. And the other side of the equation is a lot of people's jobs are changing from the standpoint that they may be going to a new job as a 1099 employee or a contractor, and that opens up a whole wide array of some of the retirement strategies that they can take advantage of.
So, Chris, what happens? Do you need to open up a SEP? What type of plans do you open if you are a contractor opening your own business and you're not in a structured corporate plan? What are your options?
Yeah, you've got to find an advisor who's very familiar. We do a lot of this work in our shop, a lot of strategy on advising these people. The easy one is the SEP IRA. The limits are higher, so people can take advantage of that. But, for example, people might be named as a contractor and they have to go out and form their own LLC. And that really opens up the opportunity for them that they can do a small business 401k, they can stack a profit sharing on top of that, or they can get really fancy if they're obviously older, they can even do a defined benefit plan. So there's a real array of strategies that they can use to really max out and really put extra money to work in a high-powered retirement plan. And a lot of people don't think about these things. They're too busy changing their job, the status, and what they're doing. And they really need to strategically think about this going forward because it could be a very good benefit for them in the future.
Right. And Chris, you're not only just advising on the financial part of it. I mean, you really do take on a counseling role, if you will. And, I'm trying to wrap my head around the Great Resignation. I can't imagine being at this point in my life and not having a plan B in terms of a career. And I get all the reasons why people are, participating in the Great Resignation, job burnout, want to take a more entrepreneurial role. Perhaps they just want to take some time off. So how do you counsel clients through job changes and job status? I just know myself, I'd panic if I did not know that there was a steady stream of income or insurance benefits lined up. How do you work with them through this?
Yeah, the conversation is changing dramatically. I mean, most RIAs the last couple of years are like, hey, you're going to be working at this job for the next 20 years. You're going to be saving so much a year. Here's what you're going to be doing. And in the last 18 months, that's been blown up. And we're really having much in-depth and candid conversations with people. How much leverage do you have? I mean, how much debt? If you have a large house with a big mortgage, your options may be much less than somebody who's, been financially more astute and been able to save more money, pay down debt, et cetera. So it's a very different conversation in the last 12 to 18 months that I've had in my career. It creates a tremendous amount of opportunities for RIAs who are more strategic minded with their clients. But again, it's a different conversation. And it's something that, if you have a plan B, hey, here's what we got to think about for your plan B. How long are you willing to go without an income in order to jumpstart your new career, or your new business that you have going? And what are the downfalls and what's your fallback plan? And these are the conversations we're having now.
Right, because even if you saved up significantly in your retirement accounts, and let's say you resign in your 40s or 50s, you can, but you can't just simply access it and not have to think about the tax implications. I mean, you're leaving a lot on the table by accessing retirement accounts if you have to.
Yeah, and that's why one of the things that we've actually been talking about the last couple of years strategically is for people to build up, quote, that piggy bank or savings account. We don't want them to have it in the savings account, but we see a lot of people get super focused on just having money in their retirement plan. And I've been saying for the last couple of years, you've got to start to bank that excess cash so that you have some funds available, that you can tap into depending upon what you end up doing. And where clients are beginning to understand that and hear that. And you and I have talked about the last couple of times we've been on about how much cash people are hoarding. And I think people intuitively are hoarding that cash because they know I might have to make a change. Well, it's good to hoard the cash, but you got to make sure you optimize what you're doing with that cash outside of a retirement plan. And again, these are the conversations that we're having that are much different than they were even, a year ago.
Yeah, for sure. I feel like I'll be working till I'm 80 some days. Okay, so let's turn and look at the charts because Chris, last time you were on, certainly looks very different in January than it did in December. Let's start and look at the S&P 500. Certainly a volatile start for 2022.
Yeah, this is going to go down as one of the worst starts the S&P 500 ever. Right now, if the market ended today, we'd be down 10% from the year. Now, one of the things I'm trying to keep people sane about is that you're hearing a lot of super bearish pundits come out and say, okay, we are in the next roaring bear market, down another 20 or 30%. Jill, we are beginning to see sentiment numbers that are worse, or should I say better, than in March of 2020 when the market rolled over 35% in 2.5 weeks. The amount of bearishness that's out there is almost unprecedented at these levels. And I think investors have to be very careful to knee-jerk reactions about what's happening overseas and what's happening with interest rates. We're trying to tell people you need to calm down at this point.
Right. I would also say a lot of those bear pundits have been saying the same thing for almost 10 years at this point. And this is like the catalyst to, okay, here, now my point can be made. But I think, I agree with you longer term, there's some good opportunities here, especially if you're, allocating money to your 401k, you're picking up those shares cheaper. That's what happens longer term.
Yeah. One of the things I've been saying is that you get these bear market pundits that, do this Hail Mary, markets going down 30, 40, 50%. In fact, there's a very popular article going around right now by one of the bear market pundits that we have a 50% correction coming. Now, what ends up happening, he gets a lot of press, he gets a lot of notoriety, but I always tell people, I've been doing this a long time, you never want to get too bearish and you never want to get too bullish.
Right. Well, that's why it's called averages, right, Chris? Let's take a look at our next chart here. The Nasdaq 100, even down a little bit more than the S&P 500.
Yeah, the Nasdaq ripped off a quick 15% downside. This week, we've gotten some very positive news from some of the large Nasdaq companies with very good earnings, but the Nasdaq really isn't showing the carnage in the growth space underneath the major averages. Some of the big growth companies are down 50 or 80%, from their highs last February. And so the Nasdaq is obviously following, and it's down 15%. But we had said the last couple of times we've been on, there's this rotation from growth into value. And what I'm trying to point out right now is that growth has been really discounted at this point in time, and you could see a very large counter trend rally happen literally at any time.
And Chris, the Russell 2000, I mean, this poor index, it just can't get out of its way. We thought there was a little bit of glimmer of hope, just a few months back, but the underperformance just, rearing its head again. Yeah,
been very difficult. In fact, the Russell 2000 is now down 20% from its recent high, literally wiped out almost 2 years of return. We still believe, we made the call back in November, December, that we think 2022 is going to be the year of the mid caps. I know it's not starting off very good, but we have a lot of time left for this year. And we still think that this is the space that money's going to start gravitating to. I talked to some small mid-cap managers this week, and they were telling me that some of the stocks in their portfolio have 200 to 300% growth rates over the next 5 years and are selling at such a severe discount that they can't even believe it at this point in time. So again, we haven't given up hope on the Russell. We think that there's a lot of life left in it, but it's been a scary decline. People love to sell the small mid-cap companies first and then ask questions later.
Right. And of course, Chris, we know a lot of this volatility is being attributed to what the Fed is going to do, and that's predicated on inflation. When we think about oil, that is one area that you don't want to be inflationary because that impacts consumer spend. What are your thoughts here? I mean, what are we, $10, $12 away from 100?
Yeah, and it's one of our calls this year that one of our concerns was that oil could accelerate over 100. Now, I'm going to back off of that a little bit because you can see since the low in December, oil's ran up almost $25 a barrel. We think prices are going to moderate near term. There is supply beginning to come on. We're beginning to see more supply come on in the oil area. So even though I'm worried about it going over 100, if the next 6 to 9 months you have oil back off and go into a trading range $10, $15 lower, that could easily moderate a lot of people's views on inflation.
And finally, the 10-year, another one that moves along with what the Fed policy dictates.
Yeah, and our call this year has been that, we're at the upper end of the range as far as interest rates going. We've actually been lengthening our duration for some of our clients' portfolios to take advantage of these higher coupons out there. Again, the Fed controls the short end of the interest rate market. The long end is controlled by inflation perception and people's view on the economy. And we're beginning to see numbers that say that the economy is good, but maybe not that great. I spoke to a fixed income manager. I have my view on interest rates. His view on interest rates was quite different. He actually thought the 10-year could get under 1% at some point during this year. And if you look at a longer chart of interest rates, last year, the 10-year did rally up, have a big collapse, and then start to go back up again. Again, it looks like a trading range market, and we're at the upper end of the range.
All right, Chris, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.